Good afternoon, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hopefully you guys had a great day in the markets today. And in today's action, guys, the SPY and the GOOG hitting brand new all-time highs over the course of the session, and most of your major sectors did participate as well. The most hated rally simply continues at this point. Many stocks, especially some of the growth stocks, were flying today. ASTS, Rocket Lab, and even some more consumer defensive ones such as Pepsi were catching a little bit of a bid today. Shout out to Shopify, up a nice 5.63%, and many other companies were up multiple percentage points today. I call it the most hated rally because at this point in time, during the massive tariff sell-off, people didn't actually think this was possible. But as I always say on the channel, guys, sentiment in the markets is somewhat temporary. The market will try and price in the worst case scenario, but at the end of the day, earnings per share and free cash flow growth are the two largest drivers of the market. And so far in the last two earnings seasons, we haven't really seen companies guide down for EPS. We're coming into this new earnings season, and so far the banks have reported pretty good numbers, although their stock prices did not react to the upside very much. That's of course because they have ran so much from the April lows, but their numbers were fairly good overall. Now, in today's action, the reason for the push through the all-time highs was due to a favorable retail sales report that came in very early this morning. Let's have a look, shall we? It came in at 0.6% higher on a month-over-month comparison. That was in relation to the consensus of 0.1, so beating the estimates right there, and much better than last month's report that came in at negative 0.09. Let's have a brief look at what one analyst had to say. A reassuring retail sales result comes at the perfect time as earnings season kicks into gear. If earnings are more upbeat than expected, and if management continues to tell a reassuring story about consumer spending, stocks could react favorably, even after a rally to record highs that some investors may view as overextended, which was why I call it the most hated rally. At the end of the day, consumers are the backbone of the US economy. And so today, guys, many stocks to the upside, many sectors to the upside as well. And my goal is going to be to make sense of it all for you, to provide you guys with the best insights into some trades and some long-term portfolio positions as well. So speaking about today's video, we're going to do a few things together. Number one, of course, we have to talk about three very large earnings that came out today: TSMC, Netflix, and Pepsi. We're going to cover those in just a few short moments. Thereafter, we will do our major sector analysis, doing a technical analysis breakdown of all of your major sectors, see where the rotation is and isn't. Thereafter, we will take a look at our big tech name list and see which of these companies are set up well into earnings, which could possibly be good for some swing trades, and which ones I'm holding off on myself personally. To wrap off the video, guys, we are going to take a look at our biggest gainers and losers of the day, cover as many stocks as humanly possible, and give my ideas for any trade setups if some are valid. And in terms of the portfolio update, guys, well, you know, it's going to come on the Friday session. I usually do 2 per week, but if you want to see a quick glance how we've been doing so far this week, this is this week's closed trades. A lot of wheel wins overall, one directional win. We were able to close a Pepsi after their favorable earnings push. And in spite of the fact that we tried to play earnings this week, we did have some decent wins, but not many of them moved in our favor. So we did make a little bit of profits here, but nothing overall considerable as we move into the rest of earnings season. But all in all, guys, fairly good week. These earnings plays are all just bonus plays for me at the end of the day. I like to focus rather on the wheel and all of my directional strategies, call debit spreads, leap call contracts, which for the most part have been performing very well. So without further ado, guys, that's going to be the structure of today's video. Let's jump right into it, shall we? The SPY up 0.61, brand new all-time high, and the Qs up 0.81, brand new all-time high of its own. Take a look at the heat map right here. You will see that most sectors performed very well, except, of course, for healthcare, which has been the major lagging sector of the past few months overall. Big tech having a pretty decent day, only Apple lagging a little bit behind here. You can take a look at financials. They're performing well after some of the earnings that had unfavorable impacts on the short-term price action. As we saw on the channel the last 2 days, guys, the earnings from the banks were actually really solid overall, showed that the banks were well capitalized, showed that the consumers were still healthy as well. So not surprising to see them recover after some short-term price action to the downside. And the bottom half of the market participating in today's rally as yields did make their way a little bit to the downside, as we can clearly see from these yields right here. Sorry, where are they? Our longer term yields slightly to the downside. So the interest rate sensitive sectors did participate in today's rally, and especially your consumer-facing stocks after that retail sales number did get a little bit of a push. In terms of the one-day relative performance, guys, you can see most of the market was green today, only real estate and healthcare getting left behind. But since it's been a fairly mixed week, all in all, you remember some very red days, Monday and Tuesday, depending on the sector you were looking at, right? We're kind of mixed here all across the board. Tech still your biggest winner of the week. To the downside, energy, basic materials, and sadly, healthcare. Almost down 3% on the week is healthcare. Very bad week for them. Everything from pharmaceutical companies to your healthcare insurance providers have been selling off in a considerable fashion. So before we get into more technical analysis and more sector breakdowns, let's take a look at some earnings, shall we? And we're going to start it off with the big one, which is going to be Netflix. So Netflix, unfortunately, down 1.98% in the after hours, but that is not because they had a bad earnings. They actually smashed it all across the board. But kind of as I was saying with the banks, and as I was saying yesterday as well, leading into Netflix's earnings, it's really tough to justify what's the size of this move since last earnings, guys. What is this, like 61% from the bottom of tariffs, guys? So if you really want to push higher than that, I mean, the company is already up 42% year to date. If you want to get a monster move in the after hour session, you're going to have to put up monster numbers. And all the other numbers were amazing. Beat and raise. Take a look at this beat right here. Beat on EPS and beat on revenue. But they also raised almost every single metric for next quarter and for the end of the year. But it still was not enough. Probably just because the stock has ran so much so far. But let's take a look at their earnings, guys. They were fantastic. Here's just a few metrics for you. Revenue was up 16% year over year. Asian Pacific was very good, 24% year over year, their best performing segment. Operating income, the company is making more and more profits, looking very good, 45% gain year over year. Look at the operating margin expansion of Netflix over the course of the last 8-9 quarters. Fantastic, from mid-20s to now almost mid-30s. And that's what they've been focusing on in the past year and a half, roughly, is really driving more free cash flow, more earnings per share, and more net margins, essentially, for the company, yeah? EPS, very solid, 47% year over year uptick there. So extremely solid numbers from Netflix all across the board. And here, we're going to take a look at some of their raises as well in terms of guidance for future quarters and in terms of the end of the year. Netflix posts an earnings beat as revenue grows 16% in the second quarter. Very solid numbers. The company updated its full year revenue forecast, noting that it expects revenue to be between 44.8 and 45.2. The midpoint, of course, being 45. And that was up from a range of roughly 44 at the midpoint. So nice little increase in revenue here, guidance by about $1 billion. Now, of course, it's not $3, $4, $5 billion, which would be a 10% raise, but still, guys, that is very good. Netflix's higher forecasts reflect the weakening of the US dollar compared with other currencies, as well as healthy member growth and ad sales, the company said in a statement. Netflix does no longer report its monthly subscriber or quarterly subscriber gains. It'll just say if they're going up or if they're going down. They stopped reporting that number because they wanted the Wall Street and also probably retail investors to focus on their improvements in margins and free cash flow, which I also think is a better thing to focus on overall. But this line right here, I've been saying this leading into earnings every single video for the past 2 weeks when we've taken a look at DXY, yeah? DXY, of course, being the dollar. This is the first time in almost 3 years that these companies will have currency tailwinds, meaning when they bring in foreign currencies from abroad, they're able to get more US dollars. They report in US dollars. That's better for them in terms of revenue guidance, in terms of EPS, and in terms of free cash flow numbers as well. And you can see that from Netflix's earnings presentation right here. If we move down all the way to the bottom, let me just get it for you real quick. FX impact, you can see here are all the prior 3 years, 2022, 2023, and 2024. Operating profits, the FX impact was negative, $750 million, 2022, $126 million, 2023, $419 million, 2024, and now $70 million to the upside, guys. That definitely does help and was a reason why they increased their guidance as well. I do expect that to be a common theme here throughout earnings season, especially for these large international companies that make a ton of revenue abroad. So keep that in mind. That's where some of your earnings surprises and guidance surprises may come from, because that's what's been affecting them to the negative, or to the downside rather, for the past few years. Year-over-year revenue growth was primarily a function of more members, higher subscription pricing, and increased ad revenue. Their ad tier is phenomenal. They're expecting a doubling of ad revenue by the end of the year in relation to 2024. That is fantastic. Net income right here was $3.1 billion. Net income for Netflix, guys, this is record highs right now. Their net income currently standing at the current stage 28.2%. That is up from 27.4% in Q1, which was also a record for the company. You can see a clear trend of margin expansion from the low 20s to the high 20s. That is excessively good for the company. Moving on further, free cash flow also grew, reaching $2.3 billion, a 91% increase. Netflix increased its full-year free cash flow guidance to between 8 and 8.5 billion, up from around $8 billion. Netflix emphasized its second quarter operating margin of 34.1%, an improvement of nearly 3 percentage points from the prior quarter and of nearly 7 percentage points from the year earlier period. We saw that in this little graph on the left-hand side. Clear operating margin expansion, fantastic for the company as well. However, it warned that operating margin in the second half of 2025 will be lower than the first half due to higher content amortization and sales and marketing costs associated with our larger second half slate. However, we're not going to be expecting a drop off a cliff. It'll just be incrementally lower, but as you can see, it's somewhat of a bumpy trend depending on Netflix's costs of production throughout that quarter, how many shows they're pumping out, etc., how much sales and marketing they're doing, expenses, right? So we might be expecting a slight downtick, but I think the trend is very clear for the company. Margins are up and to the right. Taking a look at a few key components that I want to show to you guys as well, guys, is in terms of the profit upticks. Take a look at net income, right? From 2.1, 3.1 billion right now. Very strong. We can see that trend in operating margins as well. Look at the free cash flow from 1.2 billion in Q2 of 2024, then Q3, right? 2.1, 1.3 Q4, which is a weak quarter because they were doing so much content production. I remember that quarter. We covered it on the channel. And now look at the free cash flow numbers, guys. Very good increase in free cash flow. And what are they doing with that free cash flow? Well, of course, they're buying back some shares. You can see a clear decrease in trend here of their share count, utilizing that cash flow well, paying back to the shareholders. Now, Netflix has been taking market share from other players so far. You can see here that YouTube is still the dominant player in terms of your, broadcast, or rather the segment of the streaming section. So there's still a lot of market share to be had, taking away from broadcast, taking away from cable, and taking away from other as well. Streaming is becoming a larger portion of this pie. The leader of the streaming category so far is still YouTube, 12.8. Netflix is right there, number 2, 8.3. But in terms of pure play streaming platforms, right? YouTube is kind of something on its own where content creators such as myself post to the platform. But if you're talking production quality, movie quality, TV show quality, documentary, although there's some nice documentaries from YouTube creators as well, but you know what I'm saying, right? Pure form content like that, Netflix is by far the leader, and I really don't think that anybody is catching up. So all in all, guys, a very stellar report from Netflix overall. Fantastic. All regions experienced healthy user growth year over year in terms of revenue growth. Fantastic, guys. There is nothing bad to say about this report. The only bad thing is that the stock price has ran so much, which brings us to the valuation question. Is the stock currently a buy right now at $12.50 with this stellar earnings report? Let's take a look at that, shall we? So 2025 forward price to earnings at $12.50 is 48.69. That is at the top end of the range. That is somewhat rich for Netflix. The PEG ratio, when we divide this number here by their EPS growth rate, which is fantastic, is still 2.11. And I mean, Netflix is growing in a very rapid fashion. Take a look at this EPS growth rate right here, going exponential. So, when I do the PEG ratio, it encompasses for this high EPS growth rate. Taking a look at revenue as well, revenue is up and to the right in a very steady fashion. So all in all, guys, even in spite of the heavy EPS growth, right, for the next few years, they're still trading a little bit rich at over a 2 PEG. That is kind of where I draw the line. Usually, in terms of PEG ratios, you want to be as close as possible to 1. If it's close to 1 or under, it's a fantastic deal. 1.5 is okay. It's still a decent buy, right, if you have a long enough time horizon. Above 2, you have to understand you're probably not getting a good deal. And free cash flow yield, although they've been improving free cash flow yield is a byproduct of a calculation of the market cap, right? Or rather, the free cash flow on a trailing 12-month basis divided by the market cap. So if the stock price runs a lot faster than the free cash flow increase happens, well, you get a low free cash flow yield. So right now for me, Netflix is not a buy, it's just a hold. In the event we somehow pull back into the 1100 range, which probably seems unlikely to some folks, but you know, stranger things have happened. You can see how extended we are on the monthly time frame here. And sometimes when we get an overall market pullback cycle, maybe you'll be able to find Netflix again in the $1,100 range. So essentially what I'm saying is, if you already have a Netflix position, you know, I'm not adding to mine, but if you are new to the market and you absolutely want to start a position in Netflix, I think the growth of this company is still going to be very solid for years to come. I think their market cap per management's guidance by 2030, they're targeting $1 trillion in market cap, and I think that is achievable. So is there still a 2x left in the stock? Yes, but it's not going to happen overnight, and it's not going to happen in 1 year. So there still is very decent upside. For me, as a longer-term shareholder, it's a hold. I'm very happy with the position that I have. It's not a bad ad. It's just you have to understand that you're buying it at a fairly rich valuation. So the time frame, the time horizon that you have to hold it for is a little bit longer if you want to really get those good compound annual growth rates. So keep that in mind. That's everything I had for you guys for Netflix. Hopefully you enjoyed. Now, stock number 2, another very large player, and that is going to be TSM. TSM had their earnings this morning before the bell. They absolutely smashed it. And that was the expectation leading into this. I was fairly clear on saying I was pretty sure they're going to smash it. And they smashed it, but the stock only up 3.38%, but also a byproduct of the fact that, I mean, from the bottom here, guys, we're up 81%. There's only so much they can do. So you could estimate that maybe some of the earnings move was already priced in, but I digress. Very solid earnings, all things considered. A beat on EPS by 9.72% and a fantastic revenue beat by 5%, guys. That's no joke. When you're making $30 billion a quarter to still beat by 5%, extremely strong numbers from TSM. Let's dive into them, shall we? So taking a look here at a few key metrics, revenue was up 44% year over year. That is ridiculous, guys, right? In terms of their 3 nanometer chips, which is their smaller chips, TSM is something like this, yeah? Every single generation, they make their chips smaller and smaller, which also makes them more efficient, more power efficient in many different ways. You can see here, they used to have the 7 nanometer chips, then they went to 5, which is the green, and now they're doing the 3. So they're pivoting to the 3. So that's why this chart focuses on the newer generation of chips that the company is producing overall. So the 3 nanometer revenue was up 131% year over year. Fantastic revenue metric from them. Look at these operating margins, guys. They've went from low 40s to now almost 50% in the span of roughly a year. Operating income up 68% year over year. These are ridiculous numbers overall, right? And EPS on its own up 67% year over year. Fantastic numbers from TSM. Nothing bad to say, but another question of the stock has ran a lot. TSM profit surges 61% to a record high, fueled by AI chip demand, as if that wasn't obvious, right? The world's largest contract chip manufacturer forecasts third quarter revenue between 31.8 and 33 billion, a 38% year-over-year increase, and 8% higher from the prior quarter at the midpoint. This is a raise. So not only did they beat this quarter, they raised guidance slightly for next quarter as well. The full year 2025 revenue to rise by around 30%. That's very solid. Last quarter, they said 25. So this as well, end of year guidance, another raise there, very solid. Let's take a look further. The high performance computing division, so essentially everything for AI and data centers, for the NVIDIA chips, for the AMD chips, for some of the Intel chips, et cetera, which encompasses AI and 5G applications, drove second quarter sales, contributing 60% of revenue. Very solid. The primary driver of growth for TSMC has been the robust demand for AI-related chips, particularly for the leading-edge nodes below 7 nanometers, which they're pumping out a lot of, as you clearly saw on this chart right there. There's really not much to say, guys. The CEO is still very bullish. Here's what the CFO had to say. Surging demand from the AI boom is highly sustainable in the near term. Highly sustainable. Keywords. With AI still in its very beginning stages and continues to expand across industries. Very key words, guys. We are still in the early innings of the AI boom, so I hope you're not tired of the word AI. There's more to come over the next 3 to 5 years, I guarantee that. Looking into the second half of 2025, we have not seen any change in our customers' behavior so far. However, we understand that there are uncertainties and risk from the potential impact of tariff policies, said the CEO, CC Wei. Other headwinds facing TSMC in the second half of the year include appreciation of the Taiwan dollar and potential order cuts from smartphone and PC clients due to global macro conditions. Once again, a soft reference to the tariffs. But overall, those are the disclaimers. But let's be honest here. They absolutely smashed it, right? Here you can see the net increase in operating margin over time, which we saw on the graph before. Net profit margin, not as high as last quarter, which was a record for them, 43.1, but now 42.7%. Fantastic return on equity for the company as well, 34.8. So they're utilizing their capital in an extremely efficient manner overall. And these gross margins are no joke too. All in all, guys, stellar quarter for TSMC. Very tough to pick apart anything negative. You can clearly see that in terms of their financials. If we take a look at their balance sheet real quick, you can see that they're flush with cash, no problems with debt at all, and also bringing in a very stellar amount of free cash flow. In other news as well, in terms of their forecast, you can clearly see the EPS is not done, guys, not even close. As a matter of fact, it's starting ramp round number 2. This was ramp round number 1. For the first AI cycle, now look at the second part of the AI cycle. The EPS is going to be insane. Look at the revenue ramp as well. It's literally starting to go exponential into the brand new S-curve, catering to those AI and data center services. Extremely strong report from TSM. But as always, the question is it a buy up here? Well, the answer actually might surprise you. Taking a look at the forward price to earnings here for 2025 at $245, which is the price after today's close, you're only trading at a 25 forward price to earnings for the end of the year. That is really not that expensive at all, guys. They're growing revenue and EPS for the next 3 years at very high double-digit growth rates. The PEG ratio is 1.5, and the free cash flow yield, although a bit low, is 2.3%. Based off of these valuation metrics alone, guys, TSM, technically speaking, forget about all this, right? Now, you should never be able to say, well, I could have bought it there, I could have bought it there, I could have bought it here, I could have bought it here, now I can't buy it. That's not how you do it if you have a long-term fundamental thesis on the business, right? You have to look objectively at the numbers. Does it still make sense to buy the stock here? And in my opinion, yes. Maybe you don't want to do the full batch, but in the event you were waiting for a bit of a pullback, you can potentially, not financial advice, but if it's something that interests you, the numbers do make sense here for a portfolio add or for a new position if you are new to the markets and new to this company overall. And the way I would structure it is I would add some here, but then in the event I find some dips, knowing that it's still a good deal at the all-time highs, any dips would also be great catalysts for possibly buying into the company. The only overhead risk that this company has had for years and years and years at this point, which by the way, caused Warren Buffett to sell somewhere all the way down there, is of course the inherent risks between Taiwan and China. If you can stomach those risks, then this might just be a semiconductor player for you. This company, guys, not many players can do without it, right? They make all of NVIDIA's chips. They make all of AMD's chips. Without them, NVIDIA wouldn't be able to pump out those chips overall. They're a key, crucial player. They have a large technological advantage. The competitive advantage and the moat of this company is staggering if you can stomach the geopolitical risks between China and Taiwan. This is one of my favorite semiconductor plays in my own long-term portfolio, and I'm not selling any shares at all. That's stock number 2. Now, stock number 3 is one that's a little bit less sexy. We're going to talk about Pepsi. Hey, that kind of rhymes. Never mind. Sorry about that. So Pepsi right here, 7.45% to the upside. And this one, guys, has been a long time coming. We've been covering this on the channel. It was getting worse and worse and worse and worse. The company started its turnaround efforts in the last 2 quarters, but those efforts have not yet come to fruition. But kind of like Nike, we were waiting for the turnaround quarter. Nike just had it, and now Pepsi, as a matter of fact, just had it as well. It doesn't mean that sales numbers and earnings numbers were fantastic, but we are starting to see a turnaround point from very poor performance to now the company having acknowledged that it had a problem, taking the necessary steps such as cost controls and restructuring to revamp those earnings and that revenue pipeline. And so far, the turnaround efforts are actually playing out fairly good, or fairly well, rather. Moving on into the numbers real quick. 4.5% beat on EPS, which was okay, but keep in mind these are sandbag numbers. They had previously reduced their guidance for the year, so they're beating weak numbers, but it is what it is. And a nice little beat on revenue here by about 2%. Let's look into Pepsi's numbers real quick. PepsiCo stock rises on earnings beat and the turnaround plan. Let's take a look, shall we? The company projected that weak North American demand will rebound as strategy changes take hold. That's what we're looking for as possible investors. Executives shared more details on the quarterly conference call about how Pepsi plans to boost its brands, lean into healthier snacking trends, and cut costs. Of course, we know that one con for Pepsi is the heightened scrutiny here. of healthcare overall, led by RFK, of course. It's going to be more health conscious. We know that there's a lot of GLP-1 secular trends in order right now in terms of, companies like Novo Nordisk and companies like Hims and companies like Eli Lilly offering GLP-1 weight loss solutions. And we know there's a lot of focus nowadays on colorants, dyes, and ingredients, all things that RFK is trying to, do away with, let's say, for the US consumer, which is a healthy thing overall. And Pepsi does acknowledge that. They spoke about it a lot last quarter to where they're going to try and remove a lot of dyes and colorants from their products and make them, quote unquote, more healthy, let's just say, right? So moving on further, CEO Ramon Laguarta said the company will hit the low end of its long-term organic revenue goal of 4 to 6% in the next few quarters due to those efforts. Prior, it was low single digits. We were talking about 1 to 2%. So now issuing better guidance than we previously had. Moving on further, Pepsi recorded net income of $1.2 billion, which is roughly 5.5% net margins. Now, that's not the best because last quarter, Pepsi actually put out 10% margins, and the longer term net margins for Pepsi is supposed to be around 10%. So this quarter, another underwhelming quarter, but they did take a hit on some things as part of a restructuring plan overall. The company is, the net sales rose 1%. The company is still seeing softer demand for its products. However, this is exactly like Nike, right? The stock popped after their earnings, but their numbers weren't that good. We're still negative, but we're getting less negative. That's what the market wants to see, okay? So worldwide volume still fell 1.5% for its food and was flat for its drinks. Volume dropped again in North America, although the CEO said that the domestic business is improving. The company's North American food division, which includes Frito-Lay and Quaker Foods, saw its volume shrink 1%, but they were planning for much worse. So the turnaround efforts seem to be paying some dividends there. Pepsi's domestic drink segment reported that its volume fell 2% in terms of domestic drinks. As part of Pepsi's strategy to boost its North American sales, it's leaning into the protein craze and multicultural product offerings like those from Siete Foods and Sabra. Pepsi is also planning on relaunching Lay's and Tostitos to focus more on their core ingredients, potatoes and corn, so less fillers perhaps. Pepsi is also cutting costs and trying to improve its profit margins. The company closed 2 manufacturing plants for its North America food business during the quarter. Pepsi also said it's trying to make its transportation and logistics more efficient. So the company is doing what it can, guys. Pepsi is a veteran of this game. It's been through many economic cycles. The company's been around since 1968 in the public market, so they definitely know their way around some cost reductions and cost repurposing and all stuff of that nature. The company added that it's evaluating how it spends its marketing dollars to make sure it's getting the best return on its investment. So those are a few, well, there's obviously much more than that, but we can't spend 20 minutes on Pepsi. All things being said, is the business looking better now after this report than it was in the prior 2 quarters? The answer, objectively speaking, is yes. The turnaround efforts are actually starting to pay some dividends. They've restructured a couple portions of their business, focusing on cost control, all things considered, and the company is just looking better in terms of its forward guidance. So I was saying it for a while, guys, over the past few months, Pepsi was indeed a buy down there. It was trading at the lowest price to earnings that it had in almost 2 decades. Not only that, it was trading at the highest dividend yield, arguably that the company ever had. So as long as you were patient enough, Pepsi was indeed a decent little buy down there. And that made sense because it had cracked through several EMAs, such as the 50 monthly EMA. The only last time that it's done that, guys, was 2008. Prior to that, you'd have to go back to 2002, the tech boom bust, right? And then prior to that, well, it usually always respected it. So Pepsi was a buy. And in my opinion, if this is the style of company that you're into, it might even still be a buy. At a forward price to earnings here of at a price of 145, forward price to earnings is 18.4, which is near the lows. The prior true lows was about 16 when it was down there. The forward PEG ratio is 2.3%, but that's not the best metric for Pepsi because it has very low EPS growth. The PEG is usually better for companies that have an excess of 10% EPS growth. Price to sales is 2.16, which is standard for the industry overall. Free cash yield of 3.6% is fairly attractive, all things considered, and it still trades at a 4.2% dividend. Not the worst pick in the world for Pepsi if you're looking for another turnaround story, Pepsi might just be for you. I don't mind it at all. Even though it has popped, guys, I still do think it's a decent opportunity to be possibly picking up some shares if this is the style of company that you're looking for in your portfolio. And with that, that wraps up all of our earnings for today. Hopefully that was insightful for you guys. Now let's jump into our index analysis, shall we? And we're going to cover these charts a little bit quickly because, well, we haven't really changed anything, guys. The longer term bulls still remain in full control, and with a brand new all-time high, that means that we might just be looking for a further expansion cycle. Your next target would be psychological numbers, 630 and then 640. The bulls are looking pretty good daily uptrend. The higher lows are still set all the way down there at about 618. In the event you unravel those over the next few days for XYZ reason, we know there can be many, you would just be looking for a little bit of a daily downtrend and a little bit of a weekly consolidation phase, all things which are healthy for this market right now. The weekly bulls are in full control. As we can clearly see, the more distance that they set between now and these higher lows at 592, the better the odds that a retracement ends up in a weekly higher low, reacting from support, which is roughly 610 down to 600. 12 EMA sitting right there, looking very strong. In the event of a pullback for any which reason, higher low into possibly higher high is probably the likely scenario for the bulls. In terms of our momentum indicators, percentage of stocks above their 20-day EMA, well, that's come down a little bit. We still have a lot of room to expand into the $75 to $80 range. Right now, we're currently sitting at the borderline between greed and extreme greed, but that doesn't mean that we can't just push up a little bit higher on these short-term momentum indicators. I'll remind you, this chart goes all the way back to like 2002. So we're not yet at the top end of the range, which could lead us to believe that might just be due for a little bit more of an expansion leg on the S&P. Percentage of stocks above their 50-day EMA is sitting at a cool 68%. Yes, it's at the top end of the range, but it can get a little bit more greedy, in my humble opinion. And this is the kicker, guys. Percentage of stocks above their 200-day EMA. We are only at 53% of all stocks in the S&P that are currently above their 200-day EMA. So the markets definitely have a bit more room to broaden out. We know that the broadening out of the market has been a thing. It definitely has been a thing. Maybe not as fast paced as certain people were anticipating, but it is definitely going in the right direction. So this can definitely expand a little bit more, and we can pick up a few more names that have been lagging behind. Moving on to the QQQs right now. QQQs up 0.81% today. Very strong day for them. Brand new all-time high. Your higher lows stay put right now at about 551, right? So if you lose these and go into a daily downtrend, it doesn't matter. Why? Because the long-term bulls are in control, and as I said with the SPY, the more distance that the bulls set in one clean motion above our higher low here at 523, the higher the likelihood that a pullback will just result in a buy the dip opportunity for a higher low and into trend continuation, as the bulls have never lost this weekly uptrend ever since we bottomed after the tariff sentiment lows. So please keep that in mind. The Qs are looking quite strong, and they are led by big tech and semiconductors still. Moving on to financials right now. Financials, interesting move by financials, right? We noticed that in the past few days of earnings, the banks had really good numbers, but just didn't get very favorable price action. But at the end of the day, right, the banks had run a lot. It may have just been a slight short-term catalyst for a pullback. That being said, it was a daily downtrend, and we were waiting for the bulls to play ball. Play ball where? Into the support range, 52 down to 50. It was a fairly obvious level, guys. Very nice daily uptrend, or sorry, this is a weekly uptrend, right? Looking for a weekly higher low and looking for the push. So we might just be looking for that. The next target for the XLF is going to be 55. We got a few more financial names that are going to report soon, but it won't be the banks anymore. No, tomorrow we actually get a very fun one, American Express. So that should be pretty fun. We also get Charles Schwab, right? However, into the next few weeks, we'll also get some very big players such as Visa and MasterCard, which, if they do report good earnings, could lift that index a little bit further. As Visa and MasterCard, they haven't really been lagging, but it's not as if they're pushing all-time highs either, right? So we do have a bit of room for expansion there in the event of favorable earnings. And keep in mind that dollar impact is going to be very favorable for this style of company. Moving on to the XLV healthcare sector. Healthcare still lagging behind. Daily downtrend, sadly, for the bears right now. Although the short-term timeframes are very messy, the long-term timeframes paint somewhat of a clearer picture. We are still consolidating right now in or around the 200 weekly EMA. Why is this important, guys? Because every time we've clipped into it, even during COVID, it has been a buying opportunity. Although the buying opportunity hasn't necessarily paid fruit yet, it doesn't mean that it's not coming, right? And additionally, on the longer term time frame, such as the monthly, we know it's a monthly downtrend, and these take a while to reverse and get the actual upswing in motion. But good thing, though, we're into a long-standing section of EMAs, And we're also into huge support, guys. So although healthcare hasn't been in favor, I am expecting good things from the overall sector, but it may take a while, right? My view on healthcare, the reason that I also position for a leap call contract is at some point within the next 3 to 6 months, the sector will start cashing favorable bids and we'll start catching up, which is why I do enjoy building positions down here, but I'm not doing individual names. I'm playing the sector overall. On to semiconductors right now. Semiconductors up 0.84%, not a brand new all-time high, not on the SMH at least, but who's in control right here? Well, I mean, the entire time it's been the bulls, but now it is still the bulls, right? So looking not too bad. Higher lows are set at the lows of yesterday, 283.69. If you unwind and go into a short-term daily downtrend, you will just need to understand we're into a bit of weekly consolidation. The first stop will probably be this guy right here, 275. The stronger level is far below here, 260 down to 240. But any pullback, guys, is just going to be for a very healthy retracement, looking for a higher low for possible further trend continuation. The sector is running hot. Weekly is coming overbought conditions, but we know the sector can actually, yes, it can actually run a little bit hotter. So keep that in mind, guys. As long as the bulls are in control of the daily uptrend, right? They can't keep shorting the semiconductor space, even if it is frustrating. It's been daily overbought for a while now. If you're looking at only one indicator, trying to short overbought conditions, it's not going to work. You need to wait for the bears to prove it to you. We haven't even lost the 12 EMA in like the last 3 months. So the trend is your friend, and always remember that. And lastly, into the Russell, 1.31% to the upside. The Russell not looking too bad. Essentially, the cleanest time frame here, in my opinion, is the weekly time frame, right? Beautiful weekly uptrend right now. Looking for essentially a weekly higher low. Rejection from resistance, which was 231 to 225. Trying to go fishing for the higher low into support 217 and a 208, establish a new temporary bottom, and then possibly take another shot at this resistance range. It's not looking too bad, all things considered. I'm still not playing growth as a sector overall. I'm playing certain pockets in terms of like other small caps and medium cap stocks, but I'm not playing the Russell overall. It's not the worst buy, but this one will need a rapid, well, not rapid, but it'll need a sustained decrease in yields if you really want to start seeing it getting the lift that some people say it does deserve. Moving on to the VIX right now, the VIX doing absolutely nothing, right? A lot of people ask me, can I buy the VIX? 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 If you want to, but keep in mind the products that you use to buy the VIX, like UVXY, I mean, if the VIX stays sideways with the downwards, slight downwards bias, it's just going to bleed, right? So I'm not a fan of trying to predict, or rather front run volatility catalysts. When they happen, I will participate because usually they last for more than one single day, right? Usually. But I'm not a fan of just buying something and holding it in the event that I'm just trying to predict the next volatility catalyst, right? So VIX is down. You guys know the drill. As it comes lower and lower, it becomes more attractive to buy long-term leap call options if you're looking to replace shares with 1.5, 2-year leaps. Not a bad proposition. I'm not saying do it on companies that are constantly breaching new all-time highs, but maybe on some high-quality companies that have been slightly left behind. Not a bad idea. And if the VIX spikes, well, you guys know the drill, right? Here is going to be a golden opportunity to sell the heck out of some put options potentially below the market. Moving on to the dollar is still not moving too much, although, I mean, we have been up net in the past 2 weeks of time. Have we recaptured any main weekly uptrends? No. So we got to see that first if you want to extrapolate the fact that this may just be an actual bottom for the dollar, and maybe we might just revisit the $100 mark on DXY. But so far, the price action is okay, but no significant trend changes to report. On to the 10-year yield right now. Well, sadly, it's just not moving, right? If you really want to see the growth stocks come alive, you have to get down below here, down below 4.25 on the 10, and down below roughly, let's call it 4.75, 4.75 on the 20-year yield. So as a result, bonds have just been doing a whole lot of nothing. It's a very, you need a lot of patience to be in this trade. It has been frustrating, but it probably will come alive as we move into the end of the year, closer and closer to those rate cuts. Now, moving into other assets such as gold. Well, gold, sadly, not doing much yesterday, guys. It was only down about 0.25%. We've been saying this for a long time, right? Gold is just stuck in a range. It's not doing anything. It's like a 100-point range, 33 up to 34. It's not doing anything. It's definitely not trending, not as much as it was here, right? So gold is not the easiest trade right now, but the bias is still definitely long in my humble opinion. It's a daily uptrend in the confines of the range right now. If you're going long, the stop loss would probably be below 32.79. If you want to take a wider view and go for the weekly leg higher for new all-time highs, the stop would be below 32.40, but it has to be down below there, guys, because if you unwind, that's a weekly downtrend, and you might just be heading into monthly consolidation, which is not the worst thing for gold, right? Take a look at the RSI on the monthly, guys. I mean, gold in recent memory, it hasn't stayed overbought for this long. The chart is very extended from the 12 EMA. Would this look so awkward? No, right? So that's why you have to keep a stop loss down below there, because you might be surprised if they start unwinding this in the favor of an equities push. Taking a look at Bitcoin right now, Bitcoin up 1.68% on the day. Very nice rally recovery here. It's been a daily uptrend this entire time, so this should be no surprise. We were commenting on the fact that, with the low of yesterday, or 2 days ago rather, this was probably your new higher low. Might just be looking for a bit more upside. Upside targets remain $125,000 psychological number, and in the event you fail the high and make the low, well, that's a daily downtrend, and you know the drill, guys. You're just heading into very healthy weekly consolidation. It's been a very nice uptrend right now, sideways consolidation where above the prior all-time highs, the bull's not giving too much back at all. After consolidation, beautiful push by the bull, so any move lower, looking for a higher low. Anything above a 98.5, looking for a higher low. For possible further trend continuation, I will be buying the dips down there if it comes and picks me up. If it doesn't, well, I've already built my Bitcoin swing trade longs and my long-term Bitcoin positions. So I'm very comfortable riding this asset for the time being. That's everything for your overall market review. Hopefully you guys enjoyed that. Now, let's dive into some tech stocks, shall we? All right, so taking a look first at Apple. Apple down about 0.07%, not really doing too much on the day, but we know what Apple's been doing. It's literally just been consolidating after getting rejected at resistance, which was 220, roughly down to about 210. Sideways action by the bulls right here. It's not looking too bad, all things considered. Apple, keep in mind, has been lagging behind the overall indexes by a wide margin. Apple is still down 16% year to date, very uncharacteristic for them, and they've been roughly in a very tight range of price action here, about a $10 range for what? The past roughly 3 months at this point, but we do have a bullish leaning bias. A few things lead us to believe that we might be getting an expansion cycle soon. The weekly MACD is not looking too bad. It's been tightening up, and now we have the semblance of a weekly uptrend looking for a higher low, and maybe just looking to build up some momentum to make an attempt at cracking the resistance range. Apple has earnings in about 2 short weeks worth of time, so we'll get to hear from them. What's going to happen with the iPhone 17 refresh cycle? What's happening with the tariffs? What is happening with the infamous Siri AI rollout? All things that I'll be looking forward to hearing in the Apple earnings, and I do still think it's a very decent time to position in Apple if you want to go for a little bit of a catch-up trade on this very solid company and this very large weight in the S&P. Moving on to AMD right now. AMD up another 0.21%, clearly above our resistance range right now. 153 down to 145. Let's just call it 155 to 145, we can say, right? Beautiful daily push right now by the bulls. This is one big daily upswing. So in the event we pull back, well, you guys know the drill, right? Where we're going to probably fall back to into the previous resistance range that will now be acting as support. Your weekly bulls are in absolute full control of this stock right now. It used to be called AMD. It used to be called Advanced Money Destroyer. Now it's Advanced Money Doubler. Nobody wanted to buy it here. Everybody wants to buy it here. You guys know how this works, right? Reverse psychology, of course, in the markets, as people know, right? Buy high, sell low is always the mantra that people say they don't want to do, but always end up doing. But we were down here buying it at the lows, and I'm very happy with the AMD shares that I was able to pick up, as now the stock from the lows is up, right? How much? 107% from the lows. Is it too late to possibly buy AMD for a long-term position? The answer, quite simply, is no. If you take a look here at the valuation in around the 155 mark, they're trading at a 40 forward price to earnings target. However, keep in mind they're growing EPS at 30% per year. That's why we use the PEG ratio. The PEG ratio is 1.33. That is still very cheap for the company overall, and I'll show you what I mean by that. Look at the improvements in EPS that they'll be making over the next few years. It's going exponential. Revenue run rate is also going exponential. I would not be surprised, guys, if AMD, with the next 6 months, is able to crack, maybe even sooner, but in the next 6 months, just to give myself a little bit of margin of safety here, $200 target is not out of the question. The valuation, even at 200, in light of those revenue and EPS ramps, is not that bad, right? So there is still time on this trade. In my opinion, you're not late. Stop having anchoring bias. Stop saying, I could have bought it down there. I could have bought it here. I could have bought it there. It doesn't matter. Look at the numbers, right? Look at the numbers in an objective fashion. Put yourself in the mindset of someone who's brand new to the markets, right? Their first day in the markets is today, and they're looking for companies to buy. They would just notice this for the very first time, run some numbers, tell themselves, is it a good buy or not? That's what the institutions do. So you guys should be acting the exact same. Moving on to Amazon right now. Amazon up 0.31% overall. I mean, it's still struggling with the resistance range. Yeah, 228 down to 217 has been troublesome for the company to say the least, but still in the context of a daily uptrend, keep an eye on your higher low, 218.75. In the event you roll this over, lose the resistance highs, and go into a daily downtrend prior to earnings, you just need to understand what the longer or medium-term bulls are doing right here. We're just going to be looking for a weekly higher low, all things considered, everything above 207, looking for a weekly higher low, and I would welcome a pullback because I would buy more Amazon shares in the mid-2 teens, 213, 212, 211, all the way down there, and if we do have a sharp and rapid pullback, I'll be selling some put options down there as well. The valuation of Amazon at 220 right now is not all that bad. 35 forward price to earnings. They're growing EPS at a very rapid rate. PEG ratio of 1.77. It's not crazy. The company's not necessarily cheap, not as much as it was down there when I was loading the boat, and some leap call options, but still manageable. I'm still a fan of buying Amazon, even up here with a DCA process. Every single paycheck, I think Amazon's going to be doing very well over the next 3 to 5 years. Nothing to worry about on this company at all. Moving on to Google right now. Google up 0.51%. Looking not too bad, yeah? They have the new daily uptrend, but resistance is a bit troublesome for the company right now. 191 down to 183 is that resistance range. In the event you pull back from here, looking for a higher low, anything above 174. Higher low may be coming down into these guys, which is what, 178, 177 for a little bit of a momentum grab. You see they tested it today, right? And the bulls bought it back. So maybe we're just looking for a bit of accumulation before making an attempt at the resistance range. Google has earnings next Wednesday, so not too many days to get that rally underway. If we come down after earnings, guys, you know me what I'll be doing. I'll be buying Google down here in around the lower 170 pocket, close to support. And if we come down there, not only will I be buying shares for my long term, but I will be selling options down here as well. So keep that in mind. Google probably going to be looking pretty good for their earnings. At about 180, the valuation is still very manageable. In my opinion, one of the best risk to reward trade-offs in the entire market right now. On to Meta. Meta was actually down 0.21%. Hasn't been an easy time for Meta over the course of the last few weeks, but it's just very healthy consolidation. Daily downtrend into our previous range of consolidation, which is 705 down to 680. All things considered, the weekly bulls are in control of this chart. The weekly higher lows are down there at 680, and the 12 EMA is right there as well. Not a bad proposition to be adding Meta, right? It's not, I mean, the valuation forward basis is a 28 on a forward price to earnings. The PEG is above a 2. Free cash flow is okay. So it's not a screaming buy, but it is a nibble for me, all things considered, guys. No swing trades on Meta for me right now, but I'm definitely not selling any of my long-term shares. They also have earnings coming up in about 2 short weeks' time, July 30th on the Wednesday. Moving on to Microsoft right now, another 1.2% to the upside. And I keep telling people it's not done until you lose the 12 EMA, and it's not done until you lose the daily uptrend. Just look at Netflix. When it lost the 12 EMA and the uptrend, that is when you went into a bit of weekly consolidation that lasted for, well, up until earnings right now. Roughly, we're into week number 3. So it can happen, but just wait for the bears to show you that that is enough. They've ran out of buyers here, and now we just may be looking for consolidation. That being said, the bulls are still in full control of this chart. Higher lows are set 497. If you flush below that and lose the 12 EMA, this line right here, and roll this daily uptrend over for the first time in 3 months, well, then you'll know we're into a phase of weekly consolidation. Where could we possibly go? Well, the only relevant area of support, because we haven't really set many on this way higher, right? At least not big ones. It's going to be this guy right here and the 12 EMA. 470 is the next location for that. We'll see if Microsoft has the juice on their earnings in about 2 weeks' time to push, or maybe they run into the Netflix effect, right? Which several other stocks have been having recently, to where they post good earnings, but sadly the stock just goes down because it's ran so much. Speaking about Netflix, here we are. It was up 2% on the day, giving back almost 2% in the after hours. So roughly, we're kind of flat. Who's in control of this chart right now, though? Well, daily downtrend, we're still looking for the bulls to try and make an attempt at reversing this into a daily uptrend. If we don't get it done and just roll this over, next line of defense down here is 1216 down to 1185. And we're just going to be looking for more weekly higher lows. Anything above 1178 is indeed a weekly higher low, possible for further trend continuation. But if you lose the weekly uptrend, meaning you smash this guy to the downside, you open up the door for a weekly downtrend, and you open up the door for very healthy monthly consolidation. It's very extended from the 12 EMA, which is why I'm waiting for the 12 EMA to catch up. If you really want to know the next area that I'd be buying Netflix, probably it would have to come down to like $1,100 for me to add any Netflix shares. I'm very happy with the positions that I built here, all the way down there. And when I first started investing in the company back there, right? So I've been investing in Netflix for a very long time. So I'm not necessarily looking to add, but if we were looking to add, probably $1,100 seems a little bit more fair to me. Moving on to NVIDIA right now. NVIDIA up another 0.95%. Strong push by NVIDIA, almost 175. Daily bulls are in full control of this chart right now. Any pullback, looking for a higher low, anything above 152. Looking for a daily higher low for further trend continuation. We have not lost this 12 EMA. Very simple, guys. You want to know when the move is done? Just watch for the daily downtrend with the loss of the 12 EMA. Then you know you might just be in for more than 1 day of consolidation. If you do see that, we're looking for a weekly higher low. And the most relevant area of support would still be 151 down to 144. So keep that in mind. The weekly bulls are in full control right now. Any move lower, weekly higher low for possible further trend continuation. At 170 right now is NVIDIA a decent buy? Well, it kind of depends on your forecast for the growth rates beyond 2026. And it kind of also depends on your time horizon that you want to hold the stock. One thing's for sure, they are trading at a forward price to earnings of 39, a PEG ratio of 1.7. That's not bad, but they have very strong EPS and revenue growth numbers overall. Remains to be seen if they can maintain this beyond 2026. The concern for NVIDIA has always been the same, right? They sell Blackwell and, H100 units at over $30,000 a pop. The MSRP should be around 10 to 12K. But just because there's an absurd amount of demand, they have a lot of pricing power right now. What happens when players like AMD join the space and the company runs out of pricing power? Well, they're not going to make as high margins. They may not make as much EPS growth as well. So the thesis beyond 2026 is still that NVIDIA is going to be a super strong company. It's just, will we have to redo the valuation to forecast for a bit lower profit growth? That is the only thing that you have to consider as an NVIDIA shareholder. But the company is a fantastic company, all things considered. I still don't see any necessary reason to sell. On to Tesla right now. Tesla's still doing a whole lot of nothing, down about 0.7 today. In my opinion, guys, it's not really going to do much. They have earnings coming up the 23rd of July, right? So next Wednesday overall. That being said, the weekly time frame holds the key right here. It's just weekly consolidation into earnings. I don't think Netflix is going to break this resistance high, 360 to 340 before earnings. And I also don't think they're going to break the support low, which is like what? Lower 250, 260 range down there. It'll probably just consolidate for earnings and guidance because we know front and center is going to be EPS, free cash flow, and net margins. Tesla's been struggling with deliveries recently. That's no secret, but everybody is focused on the long-term positive thesis, which largely revolves around robotics and, robotics in terms of Optimus, right? And then also in terms of the FSD and robotaxi rollouts respectively. So we'll get to hear how is their car business doing and how's the robotaxi doing in terms of their earnings next week. So pay attention to that. I'm still not swing trading this one prior to earnings. I would rather wait for the guidance and see how they're going to address the EPS and margin situation. Moving on to Palantir right now, brand new all-time highs again on Palantir. It wasn't looking too bad, right? Daily uptrend, downswing, not a downtrend. That would be lower high into lower low, right? And now an engulfing move, V-shaped recovery by the bulls. Any move lower, looking for a higher low, anything above 129. Higher low for possible further trend continuation. If we pull back too much, like this, it opens up the door for a downtrend. It doesn't guarantee a downtrend, though. It just opens up the door. Just something you have to keep in mind, right? So keep that in mind. All that being said, in terms of the weekly charts, the bulls are still in absolute full domination mode of this chart. And any pullback looking for a higher low, anything above 128. Same level as on the daily, looking for a higher low into possibly earnings, guys. Earnings is coming up at the end of the month. Well, beginning of the month of August, same thing, right? Keep in mind, Palantir's valuation, well, Palantir's been expensive since $100. It's just a lot more expensive right now. They're pricing in a ridiculous amount of growth for the next years. Talking about through this valuation right here, if you run any model on it, this should be technically the share price in 2029, 2030. But we know that sentiment is a very powerful thing. Sometimes it just takes over an entire stock's technical analysis, fundamental analysis, and everything in between. So this stock is largely running on sentiment right now. I'm definitely not buying any shares. I'm still holding some shares for the long term, but I've done most of my selling throughout this rally. But I'm still holding a batch of Palantir shares for the long term. It's very risky buying up here, guys. I know it can still go up. Everything can always go up, right? But there's always a degree of risk to it, and you have to understand that. Moving on to SOFI right now. SOFI up another 3.27% after a short phase of consolidation. SOFI pushing higher, never really establishing some higher lows. And that's simply because, take off the extended hours, they never really set an hourly downtrend. It's just been short-term bull control this entire way higher. This is one single push higher from the higher low of 1737. So if you start losing a little bit of ground here, we're just looking for a higher low, and the bulls are in full control, a lot of space. That being said, in the event you take back too much and wind up in a daily downtrend, let's say into earnings or something like that, or after earnings, it does something like Micron did, where it runs an absolute ton and then pulls back, or, you know, several other companies have done that as well recently, to where like Elf Beauty will run an absolute ton, hit a certain level, and then just have a healthy pullback. If SOFI has a healthy pullback, you should just rely on the weekly charts, right? Just going to be looking for a higher low, maybe back down into the sub 20s, 20 down to 18 bucks. Could be a likely pullback area. If it just keeps going, right? 23.24 is the next logical area of resistance. It is your former all-time highs set back in 2021. I know it goes a little bit higher, but in all reality, a lot of the price action was actually confined between $24 and roughly $23. In terms of the valuation, guys, if you have a long-term thesis on SOFI, I'm still not selling any of my shares, guys. At 22 bucks, the forward peg is still 1.42. Not too bad at all. And the forward price of sales is 7.4, which is also not that bad. I wouldn't be, well, let's just say it like this, right? If SOFI hits $30 at some point within the next 9 months, 9 to 12 months, I really would not be surprised. I know it sounds like a lot, but the fundamentals would support that expansion, and the bullish leaning bias of the markets possibly into the next year possibly do support that expansion as well. I wouldn't be going all in here, but in terms of nibbling or something like that, or maybe going, you know, instead of buying some shares, some maybe call options for a lesser amount than you would spend on the shares. Not a bad, it's not a lottery bet. You know, it's not a company that's cheap like down here though, but still, it could be a trade. Not my favorite trade, but it could work, right? I'd rather give you guys the odds. I'm moving on to Uber right now. So Uber down about 0.28%. We know that Uber's just been consolidating over the past few days in terms of their more recent price action. Sadly, they have now unwound the daily uptrend, closing below your higher low. So we've unwound most of everything right here, but it's not because Uber's been having a lack of deals, right? So they're increasing their autonomous ride-sharing services with Waymo in Austin. They announced 2 new cities recently in the past week or so. They also announced a deal with Baidu in China. So Uber's expanding well, but it's not showing up so much in the price action. That being said, guys, right, if we unwind into a daily downtrend here, all you need to understand is who's in control. It's clear that the bulls, right? Weekly uptrend right now, looking for a weekly higher low, anything above 82, looking for a higher low. How I'm going to play this one, if we get a bit more downside, I'll be looking to sell some short puts down here in the low to mid $80 range. And lastly, but not least, TSM with a big push today. We didn't do the technicals, we did the fundamentals, but now some technicals for you. Well, obviously the bulls in absolute full control, slight consolidation phase here, and a nice little push again. So once again, any move lower, looking for a higher low. Anything above 225, 226, higher low for possible further trend continuation. But for some which reason, if for some which reason we unwind, lose the 12 EMA, which we have not really lost, well, they tried it here, we haven't lost it in a significant fashion, like not like Netflix. If you lose it and get the daily downtrend, then you know you're into weekly consolidation for the stock. Where's the logical area that we might pull back into? Maybe some of these all-time highs around 220. The larger area is 211 down to 200. I'm not too sure we're going to get down there. Maybe the closest, because that's like 15% away, and the company's fundamentals are too strong, maybe. If you do pull back, maybe the best that you can get is like 220s. So maybe you might find me doing some swing trades down there. I mean, I have a bunch of NVIDIA. I have a bunch of TSMC shares that I'm definitely not selling anytime soon. I'm not adding up here because I'm full, but I also, as I said during their earnings, it's not a bad time to add, right? It's just that if you are adding, especially for long-term shares, your thesis should probably extend beyond 2028 to 2030, because if ever it pulls back, you're going to want to be DCAing and building a position, and it's ran very hot since the bottom, of course. That is everything we had, guys, for the market rundown. I know it was a mouthful, but thank you so much for bearing with me. In terms of your biggest gainers and losers of the day, we'll cover these very briefly. We're going to start off with the biggest losers of the day. So CoreWeave, I mean, if you guys don't know what I'm going to do with this stock, maybe you haven't been paying attention in the most recent videos, or maybe you're new. If you're new to the videos, welcome, definitely, right? daily downtrend right now. If you continue this downswing into lower 120s, you guys know what I'm going to be doing. Of course, I'm going to be selling some short puts as low as humanly possible, benefiting from the volatility. Maybe if I can find low 120s, maybe I even start building a little bit of a share position overall in the company, because it's definitely a big player in the AI landscape. It's in a favorable narrative. And these are shares that I would be accumulating to possibly ride into the next 1-2 years type of thing, right? So you may see me build a little bit of a swing trade position on CoreWeave, but a longer swing trade position. But for the short-term swing trades, rather than trying to guess the bottom and loading up on calls, I'll just be looking to sell options as low as I can below the market. Moving on to HIMS right now. HIMS down about 3.59. If HIMS, I mean, struggling with resistance clearly, yeah? 55 to 50. Clear struggle. I mean, how many times do they have to reject here before people take notice? Yeah, that being said, if it breaks down, I'll be looking to maybe sell some puts down here in the lower $40 range. I have some HIMS shares that I bought all the way down here. I'm still holding them, still bullish on the expansion of the company over the next 1 to 2 years, and that's why I'm holding my shares. Eli Lilly, I mean, maybe some people have Eli Lilly in their long-term portfolios. A few people have asked me before in the comment section. I think it's good. And yes, I do enjoy it. I do like it more than NVO because they have a broader portfolio. NVO is cheaper in terms of valuation, but Eli Lilly is just a more robust company. That being said, into support, 765 down to 728. If it's in your long-term portfolio, not a bad time to be adding. I'm not doing any swing trades on Eli Lilly, but not a fundamental add into what? A year's worth of support at this point, so not too bad. Some of the dollar stores down. This is not my favorite trade at all, but just gonna, cover the chart briefly. Any entries should probably be in the sub $100 range if you are trying to play the, swing trade appreciation for the dollar stores. Not one for me, but I know some people look at it. Micron, we talked about it yesterday, guys. Micron, I actually fired off a short put trade, 103. At the low of the day this morning, 103 for next Friday for 0.5% I got. I'll be playing short puts as long as they keep offering them to me in the 110 down to $100 range. Not a bad location also to be building some swing trades. Right now, in terms of short-term conditions, almost oversold. A couple more days of Micron downside here. You will be short-term oversold. It might just be a catalyst for, well, some short puts under the market, but maybe for some long duration swing trades overall. Take a look at Melly. We don't talk about Melly a lot, but some people want me to talk about it more. Melly is just in a phase of consolidation. If you lose these lows right here, 2, 3, 4, 1, weekly downtrend, what does that mean? Is the world ending? No, it's just monthly consolidation in a very gorgeous monthly uptrend right now. The high was there, the low is there for tariffs. Monthly expansion, looking for a higher low. Melly for me is a buy. I was very clear on this last earnings, guys. In around 24.50 or below, the company is still a buy. It's a big position for me. It's not my largest position. It's a big position for me in my long-term portfolio. It's tough to swing trade it with call options or whatnot because they're just so darn expensive. But long-term shares, I am a big fan of buying here all the way through the next level, which is the low 2000s. I don't know if it gets there, but all I know is that I will keep buying Melly to the downside. I think there's much room for appreciation to the upside on this fantastic company. Look at their EPS curve for the next couple of years. It's insane. And the revenue curve as well, looking quite solid. That's everything I wanted to cover to the downside. I hope none of you guys ask me about UNH. You clearly know my answer, right? Moving on to ASTS continues to print highs. Congratulations to all the bulls. Very tough for me to try and catch this one today. A lot of the meme stocks were up ridiculously today. ACHR 11%. So call it a short squeeze. Call it Wall Street bets on Reddit. Call it just an overwhelming amount of retail interest in these names right now. The trend is very clear. There were some consolidation periods on these stocks. QUBT, ASTS, we talked about these consolidation periods on these stocks for a while. It was probably a swing trade opportunity. QBTS, did we cover QBTS or QUBT? I forget, but they're both looking good. ACHR was also a consolidation range, now pushing higher, guys. If you missed it, you missed it. If you want to chase, that's on you. Maybe you'll make some money. Not my favorite way to trade. We were very clear on the fact that these trades are possibly very nice setups down in lower ranges, but I'm not chasing up here. But congratulations if you were positioned and now are looking into some very nice gains. Rocket Lab, I'm pretty sure I don't need to really say anything like that, right? If you buy here, you're kind of just asking for it. And I've been saying that the past 4 days. And if you would have bought, you would have made money. But that's not the point, guys. If this is the style of trading that we're looking for, just buying just blue sky breakouts like that for overvalued companies where most of their revenue is going to come 2028, guys, I'm telling you, it's not going to work in every single market. It's going to build very bad trading habits. I'd rather wait for the pullbacks of consolidation. That being said, people who did buy the pullbacks of consolidation, well, you guys must be looking quite nice right now. Now is probably a nice time, as I've been saying the whole time, consider selling some covered calls against your position, right? The worst that happens is you sell covered calls way up here and you collect some premium. And if it does go up there, well, maybe you can lock in like a 2x from all the way down there. Fantastic. Congratulations to all you guys out there. Pepsi, we already covered their price action overall. A few that I want to cover, guys. Shopify. I was talking about Shopify here, that it was ripe for a breakout. This was a bull flag, and now we're getting the expansion. You're coming into target. I did call it out on the channel, but I also called it out to my Discord members too, where I gave several trade ideas just the other day on Airbnb, Circle, App11, Shopify, and Fortinet. Two of those trades have already came into target. Talking about Circle, from here all the way into target, nice little take profit zone there. Shopify, people that took that one are nicely into the peak take profit area as well. The other one, such as App11, is still on the table, stop below there, going for the expansion. It's been lagging behind a little bit, although it does have very solid fundamentals, just has not been picked up by the market just yet, but maybe it is coming in the future. And Airbnb also, I mean, it's in a consolidation range right now. It also has not been picked up by the market, but travel stocks recently have reported very good earnings, talking about the airlines. They've said that international travel remains robust. So if I had to predict Airbnb's earnings, I assume that they would likely be good, all things considered. And we are looking for a breakout of this long-standing range on Airbnb. They've been consolidating here for a long time. Might just be due for a little bit of a breakout. So those are just a few companies that I wanted to cover. Of course, we touched upon ELF. I think that ELF is a buy down here in the lower 110 down to $85 level right there. And you're just looking for a breakout or retest right there and try to attack the resistance range with a bit more momentum. And that's kind of it, guys. I mean, that's kind of it. We can talk about many more names, but there's only so many. I mean, I guess I could bring up DEC. I've been talking about DEC for a while now, guys, right? I mean, what are we waiting for here, right? For it to drop more into the 80s? I mean, fine, okay, but how about we just DCA a position into there if it's a company that you like overall? Don't be too picky around the price, right? You're already getting a fantastic price. How much is it off the highs? 55%. What are you looking for? An extra incremental, some percentage points right there. Just DCA, right? If you're not sure, or sell some puts down there, which is what some of our members in the Discord group have been doing as well. DEC still a decent opportunity, and so is Nike. Honestly, so is Nike. I would not be surprised if this stock trends back to the $100 mark at some point within, or rather during the course, over the course of the next 12 months. Not looking too bad there at all. Obviously, there's many more plays that we can talk about, but those are just a few of the ones that I figured would be noteworthy to our analysis today. So congratulations, guys. Brand new all-time highs. Hopefully you enjoyed today's video. If you did, consider dropping a like, consider subscribing to the channel. It really helps me out to grow the channel overall. We're almost at 7,000 subscribers, guys. Another milestone. It seems as though I just started this channel yesterday. I remember a time period where I used to get like 10, 15, 20 views. And I can't thank you guys enough, man, for watching the videos, liking the videos, subscribing, all your comments. I always try to do the best that I can to help you guys out, try to see the markets as I do, try to give you guys the best possible setups, teach good risk to reward tactics and whatnot, teach different trading strategies just to make sure that you guys are always well positioned. It's fine to chase the momentum stocks, but I'm always so clear on it, guys. If you do feel like you're chasing something, take a small bet, right? Don't go all in because you feel that you missed it. That sometimes just ends up in a disaster. It can work sometimes. If you get into a bad habit of doing it, you might just lose more than you can handle, right? So be very careful with that. But very happy to have grown the channel so far. If you have any comments, of course, feel free to leave them down below. And as per usual, guys, in the event that you are interested in joining our trading and investing community, where we focus on trading the markets every day, but not only that, we also focus on building our long-term portfolios with every single paycheck. So that way we have two portfolios. One trading portfolio that we try to beat the long-term portfolio, and a long-term portfolio that we do beat the S&P 500 benchmarks overall. So if you want to join, the link is down below in the video description to the Discord. You, of course, get access to all of my trades, which is pretty much all the wheel trades, all the directional trades, such as call debit spreads, call options, leap call options, everything under the sun, pretty much, swing trades with shares. Here's just, sorry, I know this weekly recap for this week is in the way, but here's just a few trades that we've been making over the past few months. Like the green check marks are wins, the red little circles are losses. So in the event you were interested in having access to all my trades, of course, they're always for educational purposes only, right, guys? So if you're interested in getting access to my trades, you can click the link to the Discord down below. You also get access to our private morning live streams, which I do every morning for about 2-3 hours at the open. I trade live and also take all your questions on your stocks, your options, your long-term portfolios. I try to teach as much as I can in those live streams as well. If you're not there, they're always recorded. You can also ask me all your questions in our chat rooms throughout the day. I'm very happy to answer you, and I'm very fast to answer as well. You get access to our private video section, which is an educational section, how to grow a small, medium, large account as well in terms of a trading account, which strategies are best depending on the account size. Also educational videos for different options trading strategies, and also technical analysis video, fundamental analysis video, how to build a long-term portfolio as well. Everything that I don't talk about so much in these daily recap videos. You also get access to all my charts, all the watch lists, and everything that's on the charts. Whenever you see support resistance levels like this or fundamental analysis on over 200 plus companies, it takes 5 seconds. You can just literally copy all my watch lists and all my charts. It's just an added benefit for you guys. So once again, link is down below if you want to join. I am looking forward to see you in there. And if not, I guess I'll see you right back here on the channel, guys. Take care. That's it for me. Have a great rest of your evening. I will see you tomorrow after the close. Take care. Have a good night and peace.